Hi everyone. On behalf of the FSM1 team, welcome to our mid-year review 2021. My name is JP from the FSM1 team. Our mission statement here at FSM1 is to actually help investors invest globally and profitably. So among the various events that we hold, the mid-year review is one of those where we take a pause in terms of what has happened in the first half of the year and look ahead for the second half and see what we should be doing for our investment portfolios. The US markets have continued to rally from 2020 all the way to now, and in fact have hit all-time highs in recent times. Interest rates have also been at super low levels, and there's a lot of liquidity going into various investments. When markets are flush with liquidity, there can be a rush towards all types of investments, and often these investments may be lacking in terms of fundamentals, or they are trading at unreasonable levels. So are there signs of irrational exuberance, to use the words from Alan Greenspan that he used in the 1990s when he was the US Fed chairman? And is it normal and reasonable to actually expect markets to keep surging to all-time highs, to see bubbles in certain investments keep going on and become the norm, and to see interest rates perhaps stay muted and low for many years to come? Is it normal as well to see fundamentals go down the drains? What are the warning signs and risks we should be keeping an eye on as investors? And when does investing actually become gambling? So these are some of the questions that we'll be asking to our panelists, and our presenters and analysts will be sharing their views with you tonight. The first part of tonight's event will be a panel discussion, which will be then followed by our presentations by 4 of our analysts afterwards. In our panel discussion, we will be looking into this question: investing versus gambling, following a long US bull market. In addition to the panel discussion and presentations, we have also organized some activities for you to take part in this evening. So if you're watching this on Event Live, you can actually scroll down and click on My Profile and Promotions, where you can view the details and take part and win for yourself some prizes. If you have any questions regarding the presentations tonight, do leave them in the Q&A section, and our teams of analysts and investment advisors will be responding throughout the course of this evening. We would like to also run a poll with our investors and audience, so if you're on our Event Live site, click on the Join Poll button to take part. So we'll move on to the poll questions. So we have 4 for you at this point. So the first one: which of the following market crashes have you experienced as an investor? I think this question kind of tells us whether we are in certain age groups or not. I'm not sure whether the results here are accurate. But let's move on to question 2 in any case. So have you heard of meme stocks? And/or have you invested in them? Okay, the answers here look kind of a bit more intuitive. So most of the investors polled have answered yes, about 2/3 of them. Moving on to question 3, have you bought into cryptocurrencies? And the majority of you in the audience chose the answer no, too volatile and risky. And I think based on our point of views in our panel discussion later, I think most of you then may agree with what we will have to say. So question 4, would you invest in a stock tip given to you by a friend or something that you've seen in an internet forum? So most of you, almost 80%, have answered would do lots of research before considering, which is excellent. So thank you so much to all of you in the audience for taking part in the poll. So for tonight's panel discussion, we will kick off with 4 members from IFA's portfolio management and research teams, namely Kenny, our investment director. We also have Wei Ren, our senior portfolio manager. Next, we have Colin, assistant manager of our macro research team. And Ziyang, our portfolio manager. So I'll be inviting them to each speak on their respective topic, and I'll be asking them a couple of questions after they are done. So we'll start tonight's panel with Kenny. He'll go back to history and look at some of the investment bubbles that happened, what we can learn from them, and whether there are signs of such irrational exuberance in today's markets. Kenny, please.
Thank you, JP. I suppose I'm the oldest amongst the panel speaker here. So it may be most appropriate for me to bring you back to history. And again, you can guess my age by looking at how I can tell about the history. But first, let me just share with you. Next slide, please. Four of the most dangerous words in investing. Every time you hear people saying, this time is different. I've heard this over the past few crises, and every time there will be excuse telling you, how different it is this time. That's why the market should continue to go up. Let me first take you back to when I first started in the industry. Next slide, please. I actually started in 1991 as a treasury analyst, and had a good few years when the ASEAN market, at that time the in markets are not the North Asia market like China, they are the Southeast Asia markets. They are the kingpins. They were the kingpins then. And that time the market was doing very well, and again, because of low US interest rates, a lot of the corporates in the Southeast Asian countries are borrowing a lot of cheap US dollar, convert into their respective currency, and some of the currency are pegged against the US dollar, so there's no exchange risk in a way. But then when US start raising interest rate in the 1996, 97, everything just unwind, whereby a lot of the exchange regime broke down. It started with the Thai baht, followed by the Korean won, Indonesian rupiah. And what happened was panic just spread across the market, and as a result of that, the market collapsed 67%. So that was one of the darkest moments that I've experienced. Then let me take you to the next slide, which basically shows you perhaps somewhere closer to perhaps a lot of you there, the dot-com. That was in year 2000 to 2002. I remember that time, if you are not aware of any dot-com startup, then you are not considered as a acute investor. I remember even Warren Buffett at that time was kind of like being challenged as, your investment approach looking at fundamentals, is it too old-fashioned? And a lot of those dot-com companies, they are flush with cash, so money comes very easily to them. Liquidity was very abundant in the market at that time. And look at what happened after things unwind. The market crashed close to 50%. And a lot of them, what we call the dot-com company, they have no revenue model, they have no P&L, and they were just an idea, a hope, and a lot of them had their bubble burst. Then I think forward to 2007, the global financial crisis, I believe a lot of people here would have experienced that. Again, that was an era whereby, money just flow into, and it's more prevalent in the US market, whereby the housing bubble was created. I mean, everyone in the US just believed that, the property cycle will just go one way up and it will not collapse. And a lot of, investment were being structured in such a way whereby, the collateral debt obligation, which is in a way, trying to bundle up all those, housing asset and then try to sell it to investors. Again, that unwound and the market collapsed more than 50%. And that was, again, you can see some of those big companies like Lehman Brothers also going under. The next slide. So right now, I think after the GFC, everything seems to be very smooth sailing. In fact, the market has gone up 400% since the GFC. And in the middle, we have a bit of a hiccup along the way. In 2018, you know, the ex-president of the United States, Trump, had a big kind of fight with China. So the trade war actually triggered some correction in 2018. But that correction was only about 20%. So you wouldn't even call that a bear market. The scare actually came last year, in the beginning of last year, whereby the COVID pandemic struck. We are still, unfortunately, in the midst of it. And the market, as a knee-jerk reaction, fell 35%, but recovered very, very quickly. Again, helped a lot by the central banks, helped a lot by the low interest rate environment that we are currently experiencing. So what I'm trying to highlight here is that, you know, over the past 3 decades that I started my investment career, I've actually seen 3 major crises. There are 2 more minor ones. I don't even call the COVID one a crisis, because before I get to be afraid, I do a lot of adjustment, the market start going up again. So, so what I'm trying to kind of like alert investors here is that, you know, there will be times whereby the market will suffer corrections, and I think it's important for you to be prepared for it. And in the next slide, what I'm trying to illustrate to you is also some of the signs of irrational market exuberance, what Alan Greenspan words is like, you know, what we are seeing, for example, in the crypto world. My colleague later, one of the panelists will illustrate a bit more. You know, people flopping into crypto, you know, the volatility that we have seen here. I'm glad to see the poll that, you know, not a lot of you believe in crypto and kind of never participated in it. And then the likes of the meme stock, whereby, you know, the likes of GameStop, AMC, those are the ones that the retail investors, or what I call retail traders, like to play with. There's also ways to raise money out in the market. The likes of SPAC, special purpose acquisition, company, whereby it's like a blank check company. They raise money from IPO and then they merge with some unprofitable company, and they can go. In the past, we used the term backdoor listing for that. So I think what we are seeing here is that there are definitely quite a bit of signs of market exuberance. But more fundamentally, what I think is more concerning to me is actually, there has been a lot of ignoring of some of the inflationary threat that is coming out from the market. You look at the commodity price. The current commodity prices are at all-time high or close to all-time high. The previous all-time high was back in 2011. And the investors, a lot of investors out there are assuming that, you know, this low interest rate environment will stay forever. And as a result of that, the central bank will continue to pump liquidity. So that, to me, is also a kind of a sign of exuberance. And last but not least, you know, when your son or daughter or your friends who are inexperienced investors tell you that, you know, I'm a better stock investor than a lot of those so-called professional investors, I think that kind of worries me a bit. I heard of my friends' children who believe they can make a few $100s a day so they don't have to work after graduating. I think that again is some sign of exuberance that you can see in the market. However, the last slide, which I would like to end my presentation with, because I don't want to be termed as Mr. Doom as in this panel. So I think the good news is that if you are prepared for the next downturn or correction, and focus on fundamentals, I think you will emerge a bigger winner in the next uptick in the next correction, and then the next uptick of the stock market. The good news is the average bear market you have seen over the past couple of decades, they only last quite short for a period of about 1.5 years to 2 years. And then more recently, a lot of the correction has also been much shallower and quicker to turn around. And most of them lasted, just around 100, 110 days. So I think my message to you is just be alert, be aware of the kind of signs of exuberance in the market, and get prepared when the market corrects in a way whereby you see fundamentals appearing, value appearing. Then I think it's a good time for you to get back into the market. With this, I'll pass you back to JP.
Yeah, thanks, Kenny, for sharing your insights over the past few bubbles that have happened in the global markets. So I'll just ask you a question on the various examples that you have shared in terms of some of the possible bubbles that you see. You mentioned cryptocurrencies, for example. Many variants there, not all born the same or equal. You mentioned specs as well, and some of the other meme stocks like your GameStop. So in your opinion, what looks like the biggest bubble right now, and why?
Yeah, I think what is concerning right now, of course, you go to the crypto world. I think a lot of volatility out there. I don't think the cryptocurrency is for the faint-hearted. And secondly, when money gets too easy, you have people investing in what they call the meme stock. They are not actually investors. They are actually stock traders, stock speculators. They hope to make money just by staying through the night, watching the U.S. market. I think those are kind of indication, as I mentioned earlier, that this bubble is definitely going into the mainstream to even a man on the street. So that is something that I think we should be watchful about.
And Kenny, on one of your last slides, you talked about the duration of bear market corrections and how that has become shorter, let's say in the last 1 decade. Are you expecting, a certain correction that could be a bit sharper in the near future? And what should investors like ourselves do when something like that happens?
Yeah, that's a good question. In fact, I'm not here to tell you to try to time the market, because timing the market is really a very difficult thing to do. So what I'm trying to say here is that be prepared. So for example, if you think that there's exuberance in the market right now, have some reserve that you can prepare yourself for correction, and then focus on the basic of investment, which is looking at fundamentals, looking at valuations. So I think that would be the best way, to deal with this market. And to start off with, personally, this is my personal opinion, I think there should be a market correction within the next 6 to 12 months. And I think the catalyst for this market correction will be a reversal in interest rate. And inflation rate, perhaps people think is going to be very transitory right now. In fact, turn out to be much nastier. So that could be some of those, black swan events or indicators that investors should keep monitoring.
Yeah, thank you very much, Kenny. So we've heard from Kenny, and we next have Wei Ren, who will be sharing his thoughts on greater full investment strategy and pump and dump schemes. Over to you, Wei Ren.
Thanks, JP. I think Kenny has given us a very comprehensive overview of market bubbles in general, but there is currently no consensus as to what are the exact reasons causing asset bubbles and the exact reasons that causes asset prices to stay elevated over a long period of time during a market bubble. So a couple of concepts have been proposed in the investing community, and one of that is actually the greater full investment strategy and the existence of pump and dump schemes. So I'd like to spend a bit of time talking about these concepts and how they actually do contribute to market bubbles. So what is the greater fool investment strategy? So this concept is really the idea that an investor can make money by buying overvalued assets and selling them later for a profit, because it is always possible to find somebody else, who is also foolish enough and willing to pay a higher price for that same asset. So to some of us, it may not make a lot of sense. It may be very counterintuitive, and it may be even foolish to want to even buy overvalued assets. But to the person who is buying the asset, it doesn't really matter, because as long as he or she is able to find somebody who is even more foolish, a greater fool, who is willing to pay a higher price compared to the price that the investor paid, then the investor can still make money by buying overvalued assets. Now, this is a bit of it is not really investing, because these investors who believe in the greater fool investment strategy, they do this without considering the fundamentals of the security or the stock that they are buying. So it is not investing, it is more of a speculation, and this speculation is based on the assumption that the investor is always able to find a greater fool out there who is willing to pay a higher price compared to what he originally paid for. So I'd like to also just use an example to illustrate the concept of a greater fool investment strategy. And I think the best example to use in this case is actually the tulip mania that took place in the Netherlands back in the 17th century. So if you look back at what happened in the Netherlands back then, so tulips was at the center of this market bubble, and back then the role of tulips was such that they were sought after by the Dutch as status symbols, which also means that the primary demand for tulips actually came from the upper classes. So basically your rich people, because they sought after these things as status symbols. But after a while, as demand for tulips started to increase, the prices of tulips also started to increase. And it was then that some traders or some investors realized that they could actually come into the tulip market and make a quick profit off it, because the prices is constantly rising. So that attracted a lot of people. The prospect of quick profits attracted a whole new profile of tulip traders who had absolutely zero interest in tulips, and all they were interested in was the profits that the tulips could generate. So a lot of them came in, and there was a lot of speculation, and the prevailing assumption back then was that it doesn't matter what price you pay for the tulips, because you will eventually be able to find somebody else out there who is willing to pay an even higher price than you did. So a lot of people came in to flip these tulips for a quick profit. And this speculative behavior actually drove the prices of tulips to ridiculously high levels, because at one point, a tulip bulb actually can cost investors up to 5,500 guilders. And to give you a bit of context as to how much this is worth, this 5,500 guilders can actually buy people a luxurious home back in the Netherlands in those days, which also means that in today's money's terms, this 5,500 guilders, it's probably worth millions of dollars. I know some of you might think that it is probably quite stupid, foolish, and insane to pay millions of dollars for a single tulip, but this was what happened. And the reason why that happens was because of this greater fool theory that was fueling this kind of speculative behavior in the market. And as we all know, there came a point whereby there were no longer greater fools out there. There were no longer people who were willing to bid the prices further up, and this was the point whereby prices started to collapse. And the people who were hoarding the tulips eventually found that there was nobody who wanted to buy those tulips from them, and they naturally set on a lot of losses based on the tulips that they had in their inventory. Now, another related concept to the greater fool theory is the existence of pump and dump schemes, which has also contributed to asset bubbles over time. And to very simply put it, pump and dumps are really manipulative schemes that attempts to boost the price of a security through false, misleading, or greatly exaggerated recommendations. Now, a lot of all these masterminds behind the pump and dumps, they typically have an established position in the company or the asset that they want to promote. So it is in their interest to manipulate the price of this security upwards, create a lot of hype, make it viral such that they attract a lot of foolish investors in. And once the price of this security is at very inflated levels, this will be the time for the masterminds to actually dump their stocks onto these foolish investors that just come in, lured by the prospect of quick profits. So which is why, which brings me to the next point, that you need greater fools in order for a pump and dump scheme to work. And this is how it is related to the greater fool theory, because for a pump and dump to work, you need a lot of these foolish investors to come in. You need these foolish investors to come in to manipulate the price, or rather to pump up the price upwards, because without them, you probably won't be able to see a lot of these speculative actions that will drive prices upwards. So a lot of these pumpers, they make use of social media platforms like Reddit, TikTok. Some of them even enlist the help of influencers to help them promote these securities on their TikTok accounts. And forums like Reddit, these are very fertile ground for pump and dump schemes, because there are a lot of investors out there who are just looking out for the next hottest investment, the next investment that can give them a few 1000% returns. And these people are usually the ones that fall prey to the pump and dump schemes. So are there examples of pump and dumps in the current market right now? I would say there are a lot of examples. I think Kenny has mentioned a number of them just now. Meme stocks is one of them. There is absolutely no reason why anyone would want to buy things like GameStop and AMC. But the thing is, a lot of these pumpers, they could say anything that they wanted on these forums without any consequences. So they started making broad claims about these companies and started rallying the masses to buy up all these companies and pump them up to very high prices. And after that, cryptos was the next pump and dump. I know some of you probably are fans of Bitcoin. I saw a small percentage of people buying cryptos, probably Bitcoin. Some people argue that Bitcoin it's not a pump and dump, but I think things like a Dogecoin is a blatant pump and dump. It is a coin that started off as a joke, and if you look at its coin design, it also looks like a joke, and also it has almost zero real-life applications. And for an asset like this, it's practically worthless. But again, people started to make broad claims about how it will eventually replace the US dollar, and you have also got prominent people coming in to pump up the price, including people like Elon Musk. So eventually, Dogecoin rallied to the point whereby even the founder said that 99.9% of the rally is actually driven by the existence of greater fools. And besides the obvious areas like your meme stocks and cryptocurrencies, I think private equity is also an area whereby there could be the existence of pump and dumps, especially for IPOs. I'm not trying to say that all IPOs are bad, but there are some IPOs that are pump and dump schemes. And I think one example that I'd like to point out here is WeWork, because WeWork has actually branded itself as a tech company when it tried to go IPO a couple of years back. But the truth about WeWork is that it is actually not a tech company. It is more of a real estate company, a hyped up real estate company that is trying to masquerade itself as a tech company to try to draw investors in. And I think investors nearly bought into this hype, because they were actually valued at $47 billion US dollars at one point. But fortunately, there was a happy ending to this episode, because investors eventually realized that WeWork's business model was a bit dodgy. It was trying very hard to make its business model work. It was burning lots of cash, and the founders and also the early investors, they were just trying to dump this worthless company onto investors who probably would have been fooled by its claims that it is actually a tech company. So when investors realized that, WeWork was forced to actually pull and cancel its IPO. So there was a happy ending to this particular episode. Now, I talked a lot about a lot of these meme stocks, these greater fool assets, and as well as pump and dump schemes. Now, if you were to participate in all these greater fool assets, what is the danger to you? Now, the danger is that we will eventually run out of fools, because there will come a point whereby you realize that you will not be able to find another fool out there, another more foolish investor out there who is willing to take the asset off your hands at a greater price, which also means that there is the possibility that you could end up being the final purchaser of this security before the crash. And to add on to that, it is also impossible to know where the top is, and when the prices eventually come crashing down, investors can lose a lot of money, especially if they borrowed money to buy into the mania. So I just want to wrap up my short sharing today by showing this one last slide, which I think is probably the most important slide today. I'd like to just end off with this message that actually investing is actually not a game. If you find that you are having a lot of excitement doing investing, there's a good chance that you are probably not doing investing right. Investing is meant to be boring, and there is only one form of intelligent investing, which is to figure out what something is worth and buying it for that price or less. So if you buy something without knowing what value or what the fair value of the asset that you are buying is, then you are probably not engaging in intelligent investing. And any other things that is outside of this relationship between price and value is considered irrational and speculation. You are actually gambling if you are participating in any of these greater fool assets. But of course, a lot of you will probably still go ahead and buy all these speculative assets nonetheless, even after today's event. We can't stop you, but a word of caution is that if you are going to gamble, at least gamble with the amount of money that you can afford to lose. So I think that's really the key message that I want to bring across to all our investors today. Yeah, so with that, I'd like to just hand the time back to JP.
Yeah, thanks a lot, Wei Ren. So Wei Ren just shared a continuation of what Kenny started off today in the panel discussion. So I'll just ask Wei Ren a question quite similar to what I asked Kenny as well. So which investment do you think is attracting the most number of so-called foolish investors or euphoric investors at this point?
Well, I think the first place that you can probably look at is Robinhood, because Robinhood has a huge base of retail investors who are really into all these speculative stocks. And if you look at what they are buying at this point, I think Kenny has already pointed out a lot of these investments that people are still chasing. So your meme stocks, cryptos, they are still very fertile grounds that investors are in for a quick profit. So these areas, they are still in bubbly area, and there is a lot of euphoria at this point. But I think one area that is probably not so obvious, I think it is in the area of high yield bonds, especially the US high yield bond market, because the reality is that we have been living in a very low interest rate environment, and the behavior of fixed income investors is such that they are yield seeking. So when you have your investment grade bonds giving you very low returns, they are pushed to take on higher credit risks, and they are attracted by the allure of higher yields that are being afforded by all these junk bonds. But if you look at the situation of the high yield bond market right now, I think the yields that are being offered by these bonds, they are at historically low levels. And on top of that, the credit spreads. Credit spreads essentially measures the amount of the reward that you get for taking on additional credit risk. Now, this credit spread is also at a record low at this point in time, which means that investors are increasingly taking on more credit risks and accepting less and less reward. So to me, that is a sign that perhaps there is a lot of euphoria in the market right now. I'm not saying that a crash is coming, but what I'm essentially saying is that I think investors have priced in extremely high expectations for this market, and there is very little margin for error. And if, like what Kenny said, something unexpected happens, if there is an unexpected setback, then what we will see is probably a pullback. Could be a sharp pullback in the US high yield bond market.
Yeah, thanks, Wei Ren. I think it's interesting that you brought up one segment of the fixed income market, in particular the US high yield market, as one area of possible concern, right, for investors. And I also wanted to ask you, when there is the possibility of a bubble bursting, let's say in one of these risky investments, what kind of possible contagion effect will it have on the broader, markets, and even on investments that are considered sound and safer in nature?
For things like meme stocks and your cryptocurrencies, the impact is actually very hard to analyze. But if you go back to the earlier episodes that took place this year, and you analyze the impact of the sell-off on the broader market, for instance, like the S&P 500, in the short term, there was a bit of a market volatility, but you also realize that eventually the spillover of the impact of the sell-off in meme stocks and the cryptocurrencies, that actually had a limited impact on the broader market. But if you're looking at legitimate investments, like let's say US bond market, if we see a 40-50% crash in the US high-yield bond market, then there could be implications for the broader market. Because if we look at the history, if there is stress in the credit markets, there is a very high likelihood that this could end up there could be contagion effects on the broader markets, and it could spread into, let's say, your equity markets, and we probably will see a string of defaults, especially if the availability of credit becomes tighter.
Yeah, thanks a lot, Wei Ren, for sharing your thoughts on this. And I guess that's where investments that are sounder in nature, based on fundamental factors. For example, value investment metrics and so on, maybe they could shine in the longer term, even when there's a contagion effect happening, let's say. And Ziyang will be sharing more later on in the panel about some of these value investment opportunities that he sees. But before that, we'll get Colin, who heads our macro research team, to share his views on interest rates. And I think interest rates is kind of linked to something that Wei Ren shared just now. US high yield, a bond segment. So, there's an inverse relationship, a classic one between bond prices and interest rates. And I think maybe perhaps a lot of investors and even central banks are expecting interest rates to remain very low for a long period of time. But I think Colin will be sharing his views as to why there could be a reversal in interest rates in the next couple of years. So Colin, please.
Yeah, thanks, JP. I think that's a very valid question here. Certainly, I think investors around the world, even within US, even in the other DMs or even EMs, have benefited from this low interest rate environment. So a couple of asset classes that have seen these tremendous benefits are, of course, your meme stocks, your cryptocurrencies, as well as some of the growth stocks, or even your high yield markets, as well as your long bonds. So certainly, there's a lot of asset classes that benefit from that. And moving on, we definitely see a change or a shift in the macro regime, and that shift itself would definitely bring much more new opportunities, but more importantly, also a lot of different risks to the current asset classes that benefit from that. So with that said, and having set the kind of context, over the next couple of slides in this short presentation, I will go through what is the inflation outlook that as a house we see moving ahead, as well as the impacts on the different asset markets, and as well as the big questions of the change in the interest rate cycle over the next 2 years. So from this slide, you can see it summarized pretty well our view on the inflation outlook right now. So on the chart on the left-hand side, which shows you, which breaks into the component of your core PCE inflation. The components are your sensitive as well as the non-sensitive components. So what I do mean by sensitive is components that are goods that are more sensitive to the COVID, to being affected by COVID. So when it comes to sensitivity, it is being measured by the quantity as well as the price change that has happened because of COVID. So if I were to draw your attention to just the last 2 months, you can see what a huge spike the sensitive component made up of the entire core PCE inflation. In fact, there's up to 70% of the core PCE inflation is being made up of your sensitive components. And yeah, moving ahead, we do see that this sensitive component will so slowly and start to decrease as your economies reopen and as your supply chain, your bottlenecks, all this slowly ease. Even though that will ease, but we do not think it is at a very rapid pace, because as economies reopen, we do envision a so-called staggered sequence where certain regions reopen, followed by the other few regions. So what we see now lately is the reopening of the US. So we are expecting a reopening of Europe, and as well as some of the other Asian markets and the remaining of the EM markets. So as that happens, we're likely to see some of this transitory factor clear up, as well as the base effect being wear off. But however, with that said, we do see some kind of sticky inflation in the data right now. So I would like to point out that one of the main culprits of where sticky inflation will likely come will be from the US housing markets. So as shown by the chart on the right, you can see the housing market price being plotted against the PCE component of housing-related inflation. So bear in mind this housing-related inflation itself makes up of around 19 to 20% of your core PCE. And what is shown on the chart right now is that US houses, a median sales home price has risen about 25% on a year-on-year basis. And that itself leads the housing inflation by around 13 months. So with that said, we can definitely expect the inflation, that housing-related inflation has bottomed out and will likely increase over the next 1 year or so. And this tends to elevate your core PCE number, which essentially is the value that the Fed looks at when it comes to making interest rate decision. So with that said, let me bring you through the next slide shown over here, so you can see the different inflation scenarios that we have prepared. And investors do have to take note of these two scenarios. First, we have the central case, which we think is the one with a higher probability of happening. And then we also have a hawkish case, which even though there is a lower probability of it happening, but we do caution investors to take note of what are the kind of signals and signs of this hawkish case, as well as certain impacts, because both central case and hawkish case, there are wild and very different impacts on asset classes, and it serves investors well to be prepared for even both scenarios. So let me just quickly go through the central case right here. So for the central case, we do expect the core PCE inflation to settle between around 2 to 3% over the next 2 years. So within the next 2 years, we're likely to see inflation to fluctuate around that kind of level. And in terms of the policy rates, we do expect somewhere around 3 rate hikes over the next 2 years. And when it comes to yields, we do expect over the next 2 years, yields will range somewhere around 2 to 3% as a result of the inflation backdrop. And you can see, as compared to what we've seen across history, which is shown on the chart on the left-hand side, over the past decade, post-GFC, we find that inflation averaged about 1.6%, and even before that, around 2%. So what we are expecting right now, going into the next couple of years, we are expecting inflation to average higher than what we see over the past 10 years. So we are likely to see a higher level of inflation over the past 10 years. And to support that view, and to really support that view is the fact that we do see some level of sticky inflation, like I mentioned earlier, housing inflation being relatively active over the next couple of years. And now I'm going to try to draw your attention to the hawkish case right here. So for the hawkish case, I think our projections are much higher than what we see in the central case, because in the hawkish case, for core PC inflation, we're expecting around 3 to 4%. And as a result of that, 4 to 5 rate hikes in the next 2 years. And because of that kind of inflation outlook, as well as the policy backdrop, we're likely to expect around 3 to 4% of a 10-year treasury yields over the next 2 years. So if you can see from this slide right here, as a result of the sort of inflation outlook, we are quite certain that we are likely to see a reversal in the interest rate cycle over the next 2 years. In fact, even as early as 2022, we are expecting a reversal of this interest rate cycle. So on the chart on the right-hand side shows both the different scenarios, the central case as well as the hawkish case. So to start off with the central case first, we are looking at about 1 rate hike at the end of next year and 2 rate hikes following that in 2023. So with that said, that brings the Fed fund range to about 75 to 100 basis points for the next 2 years. And for the hawkish case itself, we are expecting 2 rate hikes next year, around the end of next year, as well as 2 to 3 rate hikes in 2023. So essentially that will bring your Fed fund range to about 150 to 175 basis points. So as you can quite clearly see, this interest rate cycle is about to reverse. And when it comes to this reversal in the interest rate cycle, we think that the Fed looks at three main criteria when making their interest rate decision. So the first criteria, of course, is having a core PCE of 2% and above. And the second criteria is having a core PCE of 2% and above over a period of time. And the third criteria is maximum employment. So with our inflation backdrop or inflation outlook, we're expecting criteria 1 and criteria 2 to be met by next year, so by the end of next year. And for criteria 3, which is maximum employment, right now when we look at the payroll numbers, we are looking at around 6 million unemployment gap from here to the pre-COVID level. So with that said, when I look at how fast the employment is catching up right now, if we are to see 0.52 million gains every month in terms of payroll numbers, we're expecting to see maximum employment over the next 2 years. However, with the average rate that we are seeing on a year-to-date basis, we are looking at about 0.42 million gains per month. So even though there are certain gaps within the payroll rate, we do believe that this payroll can definitely increase when productivity level increases and when more of the workforce goes back to, or more of the population goes back into the workforce. So this is a gap that we think can be closed, and therefore we do see the possibility of a rate hike being somewhere around at the end of 2022. Yeah, and with this possible change in the interest rate environment next year, there is certain implications on the outlook of US Treasury yields. And more certainly, we are seeing that this low yield environment could possibly reverse itself. So for, like I mentioned earlier, for the central case itself, we're expecting the 10-year Treasury yield to range around 2 to 3% next year, and markets can definitely digest this kind of level of US Treasury yields. And for the hawkish case itself, we're expecting the US Treasury yields to range around 3 to 4%. And that brings us to levels seen just post GFC level between 2009 to 2012. So with that said, we do believe that the markets will kind of struggle at the bond yields of 3 to 4%. So there are some major implications of that. So of course, if you were to expect this hawkish scenario to play out, we do believe that the so-called damage on the asset classes will come from the rate of change of interest rate. So aside from just purely the value of US Treasury yield, what's more important is the rate of change. So how fast the yields pick up when it comes to pricing in that kind of inflation backdrop. And with a 3 to 4% projection, we do expect yields to rise at a more rapid level, and it's quite similar to what we've seen over the past earlier in May as well as in April, and with that kind of speed of rise in US Treasury yields. And with that said, there are two main implications on both the equity side as well as the fixed income side. So for the equity side, most definitely we think growth stocks will take a beating. And with that said, there are two separate categories of growth stocks that I would like to, where I typically see them. So I see them as one with the higher quality ones, one with a stronger balance sheet, one with less earnings volatility, and the other one which is more of having a weaker balance sheet and having a weaker earnings. So those with a weaker fundamentals, and those are the ones that will likely take a bigger hit if your inflation were to go, or if your US Treasury yield were to shoot up to that kind of level. And aside from that, if we look at the fixed income segment there, we think bonds will be hit relatively harder. So your long duration bonds will most definitely react the most when it comes to a rising yield, and that kind of price risk when it comes to rising yield will be definitely greater than your short duration bonds. So again, to summarize, we think that if interest rate were to rise to such, or your US Treasury yield were to rise to such levels, we'll likely see your growth stocks, especially the ones with weaker fundamentals, being hit the most, and for the fixed income side, the ones with the longer duration being hit the most. So over in the next slide, you can see that despite your fixed income segments being hit in an environment of higher US Treasury, we think that is not, investors should not dismiss fixed income, the asset class as a whole, because interest rate will eventually rise to such level, which makes fixed income relatively more attractive than your equity markets. So how do we discern that? We looked at the excess yield, which is the earnings yield, minus your risk-free rate, which is the bond yields. And with that, and at that kind of level, that tells us how much or how attractive your fixed income is relative to your equity markets. So if you take a look at the table right there, for our central case for the projection of 2% to 2.5% US Treasury yield, we are looking at the excess yield of above your historical average of 3.5%, and that being denoted by a positive z-score. And in that kind of scenario, the excess yield is telling us that equity markets are seemingly more attractive than fixed income, and it definitely justifies a neutral to at least a slightly overweight allocation to your equity markets. So in the bottom half, you see the hawkish case with the projection of 3 to 4% US Treasury yield. And you can see the excess yield that is being calculated then, and that shows us that the excess yield will be lower than historical average, and which that is being denoted by a negative z-score. And in that kind of scenario, we are looking at fixed income segment being less attractive than your equity segment, and essentially your excess yield itself justifies a neutral to overweight of fixed income versus equity markets. So essentially, to sum up what I've gone through over the past 10 minutes or so, what investors do have to take note is, moving ahead, we are likely to see a macro regime change where your interest rate is likely to get higher over the next few years. And with that change in your macro regime, we can expect certain implication on asset markets, most certainly on your fixed income side as well as your equity side. And that concludes the end of my presentation. So back to you, JP.
Yeah. Thank you very much, Colin. So I just have one question which is kind of related to your last point. So, you talked about this interest rate reversal from a very US point of view. So for investors in Singapore, how should we be looking at this reversal in interest rate trends?
Right, I think with the reversal interest rate trend, the trigger is definitely at a higher inflation backdrop. So with that said, I think investors can benefit from a pro-inflation asset allocation. So I will go through some of from more of a geographical level down to the sectoral level, and how investors can execute this kind of a pro-inflationary backdrop. So on a geographical level, if we were to expect inflation to rise, in fact, we were to expect a change in interest rate environment, I think equity markets definitely will benefit more vis-a-vis fixed income markets until inflation or until interest rate rise to a certain extent, like I mentioned earlier. And within equity markets, we see there are certain regions that benefit most, and some of the regions are, in fact, Europe, in fact, Japan, as well as your emerging markets. And you have to look at the beta for all these markets versus your inflation break-even. Those markets itself have a higher beta. It means that whenever inflation goes up, we're likely to see a larger gain in those kind of markets. So all those markets definitely will benefit from the pro-inflation backdrop. So when it comes to on a sectorial basis, right? So there are a couple of sectors that will definitely benefit. So number one is definitely the commodity-related sectors. So we definitely see materials or even your industrial sectors benefiting from that. And aside from that, a more prominent one would definitely be energy sector. So a lot of people consider all these sectors as a hedge for commodities, which is empirically true as well. So some of these sectors, such as your industrial, your materials, or even your energy and financial sectors will definitely benefit from the kind of pro-inflation environment. So with that said, maybe I would conclude by talking a little bit on the fixed income markets, how to position in that kind of environment. So within the fixed income markets, like I mentioned earlier, definitely the longer duration ones we get hit more with a change in interest rate, and which is empirically true as well. So investors can definitely lean into the shorter duration ones, or even the intermediate duration ones at the value of the curve, and those are the ones that investors should lean towards within the fixed income markets.
Yeah, thank you very much, Colin. So we've painted a picture where interest rates have been low for a long period of time, where we see a lot of excesses and irrational exuberance in a number of asset classes and so-called investment opportunities, where in effect I think our panelists have kind of shared that it's like gambling. But amidst this environment, there are still, opportunities, value opportunities, and that is where Tze Yang will be coming in to share his views as to where we should be looking at these opportunities. So Tze Yang, please.
All right, thanks, JP. So yeah, I think like what my panelists have shared from the start of this panel discussion is that there is a lot of excesses within the market at this point of time. And then that has actually built onto the kind of crypto, the kind of euphoria within the crypto space, the kind of meme stock exposure as well through GameStops and stuff like that. And I think Colin has also shared in that in this environment, what we are seeing is that as majority of the economies move into sort of a mid-recovery phase, the same easy money thing, easy money policies that were necessary to boost like the economic growth around the world to get things restarted again could be really detrimental as we move into the next phase, because one of the key metrics of because during downturns, period of downturns, expansionary policy can be quite important. But if you look into further into, say, your expansionary phase, the kind of expansionary stimulus can bring up that inflation threat, and the inflation threat can actually affect a lot of your high growth stocks, your equities, as well as your your long duration kind of high yield assets, as we have seen. I think but the good thing is that there is actually still a lot of value opportunity out there in the market. So what we are seeing at this point of time is that we do see a lot of, as we are moving into the next phase, when liquidity kind of drains away and rates starts to rise, the kind of pump and dump, greater full kind of investment scheme will be quite challenged, which also means that investors who are buying into market highs, hoping that the momentum continues to bring them further, would be in for a rude awakening ahead. There will be at that point of time, there will be no fools for you to pass your hot potato to. So we believe that it's time for us to kind of sound the cautionary bell on this type of greater fool theory and strategy. I mean, a lot of investors, like I think Kenny has suggested, especially a lot of investors within my age group, they like to scalp the market to kind of make that, to kind of get rich quick kind of for on a daily basis, so they don't have to actually take actual job. But I think at this point of time, investors need to be wary of the fact that we are moving into a new regime change, and that would mean that the kind of greater full exposure could be at risk, and investors should start to reduce exposure to this category. In fact, and we should actually focus on products with higher quality as well as fundamentals, assets which we think will be a lot more resilient to the downturn or any market correction moving ahead, simply because of their higher intrinsic value. And the good news is that there's actually quite a bit of opportunity at this point of time for investors to do the switch. And there's actually three main baskets of assets that investors can consider. And over the next few slides, I'm going to explain, share more into details which are the three baskets. So for the first basket, we actually have the classic value stocks, the kind of companies that or geographical segments and sectors that Colin has briefly touched on just now, which is, say, for example, your healthcare, your materials, your financials, are such sectors because in fact, they tend to outperform growth during periods of inflationary, higher inflationary, simply due to their low duration nature, no duration in the sense that their valuations are generally quite low. And as a result, they also, of course, they're less vulnerable to that rising discount rate due to the rising interest rates. And global financials is one of such classic value sector. We think that bank as well as financial services will be able to benefit greatly from this improving growth backdrop. And what we will see for the banks especially is that loan growth will start to rise again. And as well, I think for banks, what they do is they got quite a bit of exposure or profits through the kind of rising interest. So in a steepening yield curve environment where your longer end of the yield curve start to rise higher compared to the more shorter end where the Fed is compressing it, holding it at a lower rate, the kind of steepening yield curve environment is actually very helpful for the net interest margin of banks. And as a result, all this boils out together for a very strong earnings growth outlook for the banks. And at the same time, a lot of the loan loss causes due to the kind of downturn within the economy that the banks have to take up on in terms of loan loss provision will start to recede, and their health of their balance sheet will start to improve. So as a result, we think that global financials is definitely part of that exciting value stock to kind of ride the kind of inflationary period moving forward. Second one, of course, like what Colin has just mentioned, on the geographical level will be Europe. I think Europe is another classic value play given the fact that in terms of exposure, is more tilted towards your financials, your industrials, as well as your healthcare. These three segments accounts for the largest part of the index, almost half of it. And I think it's also appealing if you look at it in terms of, having exposure to Europe means that you naturally have exposure to these segments that will do very well in an inflationary environment. And it's also appealing by the fact that in terms of PE valuation, they are a lot cheaper than their developed market peers, like your US as well as Japan. So that is something that Europe equities, I think, as it reopen ahead, this is something that, of course, a very key selling point for Europe. And of course, the next basket that we are looking at that is not just your classic value stocks, but mainly of your undervalued assets. We think that undervalued assets are not just isolated to your value stocks. In fact, value opportunity can be found in any assets that are trading below their intrinsic value, something that I think Wei-Ren has shared in his panel just now. And I think the performance of EM at this point of time, especially those of Asia, as well as Latin American markets, have lagged its developed market peers, leading to sort of a very widening valuation discount against those peers. Right now, valuations are, majority of the global equity markets, valuations are really steep, but if you look at it with that kind of backdrop, then EM looks a lot more appealing and attractive. But I think one of the key reasons why the kind of performance started to diverge was simply because at this point of time, the developed market has rising higher vaccination rate, and as a result, they are in a better position to reopen itself, to reopen their economy. But I think it's also important to remember that within the EM itself, although maybe they will struggle a little bit with their vaccination, the kind of rising vaccination as well as falling COVID cases can help the region, especially EM, Asia, and Latin America, to close out the performance gap. I think valuations are relatively cheap now, which actually provide investors an opportunity to start buying in. So, and the third and last basket, of course, is your high-quality growth assets. Something that Colin has also shared as well. For him, in terms of growth, there is two different distinct baskets within the growth assets segment. So you have your high-quality growth, your mega cap, like your Tencent, Alibaba on China, your Facebook, Google, Apple in the US. But you also have a lot of companies, high-growth companies that have no fundamentals. They simply a lot of them, maybe they are running into still negative cash flow for the foreseeable future. So at this point of time, you also may be wondering, like, growth stocks, sort of the polar opposite of value. And to that, we kind of politely disagree. We think that there is value opportunity within growth, especially in this growth, global growth, high-quality growth segment. Like the companies, the mega tech companies within your US as well as in China is one key segment. Not only are they the prime beneficiary of that long-term structural tailwinds, such as your digital economy and your remote working trends that were brought about by your COVID situation. But they also have very strong balance sheet and very stable cash flow to withstand any uncertainty, do with the global macro backdrop, as well as any pandemic uncertainty because of the more infectious Delta plus variants that could pop up in the second half or beyond, even beyond the second half of this year. And another segment that is quite notable is your China tech giants. So what we are seeing right now is there's a lot of sell-off due to the pessimism of the China market economy at this point of time. And also, of course, when it comes to the China tech, regulation is a huge thing. I think it started off with Alibaba and Tencent, and now I think the latest episode, regulators are turning their sights to TT, which is the China equivalent of Uber. And I think while this regulatory thing could persist slightly longer than what we expected it to be, I think if you take on a longer term approach, you look at 1 year or 2 years next, it's actually a window opportunity to accumulate them. I think back then in 2018, for people who have invested in this segment for a long time, Tencent also, I think Tencent and Alibaba also kind of fall foul to the regulators, but eventually it cleared up. So after they corrected, they actually saw a very strong rebound once the regulators were happy with the kind of corrective actions they did to change certain things that the regulators were not particularly happy about. And at the same time, if you look at it in terms of fundamentals, so not just your fundamentals within your US tech, your Apple, your Facebook, your Google, but getting stronger in terms of earnings. Your China tech giants are also seeing very healthier fundamentals ahead. And this could kind of ease investors' pessimism for these sectors. So to kind of do a simple recap across my presentation just now, a short presentation, is there is actually 3 main baskets when it comes to value opportunity. One is, of course, your classic value, like your global financials on the sector end, your Europe on a geographical end. But there's value takes on many different definitions. So your undervalued, your EM, your Asia, your Latin America, as well as your Asia high yield when it comes to the fixed incomes. And we think that they are still undervalued at this point of time, and valuations and performance can converge once things start to normalize. And last but not least, of course, your high quality value growth stocks, such as your US, China semiconductors, your US, China, your US big cap mega tech, and as well as your China tech companies. And a lot of these ideas will later be covered in details and in the upcoming presentation by our different UT analysts, our ETF analysts, as well as fixed income analysts after this panel discussion. So investors can actually actively look out for them in our upcoming presentation. All right, so that wrap up my short sharing. I'll now pass the time to JP.
Yeah. Thanks a lot, Ziyang. So I have a question for you, because you highlighted the very interesting and sort of like different opportunities in the 3 different buckets. So as an investor, how would you tell us to marry all these good ideas into a portfolio?
I think that's a very interesting question. That's actually a very important question. One way to look at it is really to look at it in terms of a portfolio approach. So I think if you look at the year-to-date performance in terms of different equity asset classes, you can see that equities have done a lot better than fixed income. So if you have rebalanced your portfolio at the start of the year, asset location as well, you could have been holding a lot more US and Europe equities as you may like at the start of the year. So at this point of time, you can rebalance your portfolio. But I think for the majority of the investors, I think when it comes to us managing a match portfolio, for example, it's easy with a click of a button to do minute changes to kind of rebalance the portfolio. But for the main bulk of the investors, say for example, if you only have, say, a $10,000 worth of total portfolio, that kind of changes could be like $100, $50, which is actually really difficult for you to do so. But at the same time, I think majority of us, when it comes to investing, this is just an investment portfolio, we have another stream of income through your, say, your job and stuff like that. So you may be, if you haven't been looking at your portfolio for a while, you may be holding a lot of cash due to your cash savings. So this is also the same, so the way to kind of balance your portfolio simply is to start purchasing some of the ideas that and by that nature, by that virtue of doing so, you have rebalanced your portfolio to your target allocation. So with that, I hope I answered your question, JP.
Yep, thanks, Ziyang. And Ziyang, of course, mentioned FSM Maps just now. So FSM Maps, it's our managed portfolios. And he'll be actually presenting later on as well, from an asset allocation perspective and portfolio construction and rebalancing perspective, what investors can do. So do keep a lookout later on for Ziyang's presentation. So that brings me to actually the end of the panel discussion. We still have a couple of things left for you, our investors in the audience. But before that, maybe I'll just take the chance to thank all my fellow panelists and analysts from the iFast team here. Thank you very much. I hope you, the investors, have enjoyed and gained something useful from the insights that have been shared. I'll now proceed with two more questions from our poll. Just now, a number of you took part in the various questions from our poll. So we'll just wrap up with two more questions. So I think, as you can see now, what is your favorite value opportunity right now? So that's kind of linked to what Ziyang shared in his discussion just now. So a few choices for you to choose. And we'll look at the results from you. So I think most of you chose European equities, which is one of the classic value investments that Ziyang alluded to just now, followed by Asian equities, emerging markets, and global financials. And the last question in our poll tonight, which is your favorite high-quality growth area right now? And the majority of you chose Chinese technology. So that's something that Jun, our senior analyst, will be presenting on in part 2. So that essentially brings me to the end of part 1, which is really the panel discussion. I hope you've enjoyed that. If you have any questions regarding the presentations today, do leave your questions in the Q&A section. And we will do our best to respond to your questions throughout the course of tonight. So we will now take a short break of a couple of minutes before we get Jun, our senior analyst, to present on his topic later on. Thank you very much.
Good evening, everyone, and welcome again to FSM1's Mid-Year Review. So my name is Terchun, and over the next 20 to 30 minutes, I'll be sharing more about China's technology sector and why we think the recent sell-off is the perfect investment opportunity. So here are some of the main points that we will be addressing during the presentation. So I'll first touch on the changes in China's regulatory landscape and how it has affected the tech sector so far. Next, we'll discuss the implications of the US-China tech war and how it could affect Chinese tech companies going forward. And last but not least, I'll be sharing more about China's semiconductor industry and why we think it is a good investment. And of course, throughout the entire presentation, I will also share a list of stocks and ETFs which you can consider investing in. So without further ado, let's begin. So before we dive into China's tech sector, let's talk a little bit more about China's economy as a whole. So China has come a long way since the 1980s, growing by leaps and bounds to become a global economic powerhouse. Today, it is the second largest economy in the world, making up approximately 17% of the global GDP. And with continuing economic reforms and a shift towards a more sustainable growth model, China is actually fast catching up to the US, and it is just a matter of time before it topples the US to become the #1 economy in the world. So as a matter of fact, China's economy expanded by 2.3% in 2020, making it the only major economy to report positive economic growth in what was an extremely challenging year for most countries. So part of the reason for China's rapid growth is the widespread use of technology. So for the majority of Chinese citizens, technology today has become an indispensable part of their lives, one that is hard to live without. So the importance of technology can be seen in China's stock market as well. So if you take a look at China's top 5 companies by market cap, we can see that back in 2010, the largest companies consist mainly of the banks as well as the energy companies. But fast forward today, most most valuable companies actually come from the tech sector, such as the likes of Alibaba, Tencent, so on and so forth. So China's tech sector has evolved tremendously over the last decade, and we think that it will continue to do so over the next decade as well. However, the sector is actually off to a rocky start in 2021 as the Hang Seng Tech Index, which tracks the performance of a basket of the 30 largest Chinese tech stocks, has fallen by more than 25% from its peak in February. So this sell-off, it is largely due to a combination of internal as well as external factors, such as the increased regulatory scrutiny on tech companies by the Chinese government, as well as the rising tensions between US and China. So the flurry of negative news have without a doubt shaken investors' confidence of the tech sector. However, we believe that this sell-off is actually the perfect opportunity for investors to scoop up more shares. And over the next few minutes, I will explain the reasons why. So it all started back in late 2020 when the government unveiled a new set of rules targeting the use of monopolistic practices among big tech companies. And at the same time, it also tightened rules on the online lending sector, which eventually led to the suspension of Ant Group's $34.5 billion mega IPO. And regulators also launched investigations into Alibaba and Meituan for their alleged use of monopolistic practices, causing both companies' share price to fall. So the increased scrutiny on tech companies, it sets the tone for the future, with many expecting the country's market watchdog to tighten rules on the tech sector even further. So despite the changes to China's regulatory landscape, we think that investors should not be overly worried about the increased regulation on China's tech sector. So the government has made it clear that the main purpose of this increased regulation is actually to safeguard consumers as well as to promote the healthy growth and the healthy and sustainable growth of China's technology sector in the long run. So the rules are not meant to stifle the growth of tech companies. On top of that, it has also acknowledged that the tech companies, they played a crucial role in stabilizing the economy during the pandemic, as digital services have allowed their businesses as well as individuals to carry out their daily activities with as little disruption as possible. And through this, it is evident that the government recognizes the value tech companies have as China undergoes a massive digital transformation. More importantly, investors should also know that the majority of the successful Chinese tech companies are where they are today mainly because of network effects such as WeChat's ecosystem as well as superior product offerings, rather than relying on significant anti-competitive behavior, which is what the government is trying to deter. So although it might seem a little bit counterintuitive that we think that tighter regulations are actually necessary, as the loose regulatory environment in the past has allowed these companies to grow into the giants that they are today. However, because many of them have now become systemically important to China's economy due to their involvement in financial services, for instance, your Alipay, WeChat Pay, some form of regulation is necessary to ensure that they do not take on too much risk. So given how competitive the tech sector is, tighter regulations, it could also be a way for China's government to preserve the country's innovative spirit by protecting young companies, giving them a chance to develop. So this is very similar to what the government did in the past for today's big tech companies, during which it shielded them from the threat of foreign competition contributing to their rapid expansion. Last but not least, China is not the only country that is trying to regulate big tech companies. So over the past few years, there has been increasing calls for greater regulations over big tech companies from policymakers in the US as well as the Europe, as these companies, they play a significant role in the economy as well as our lives. And from this perspective, we think that China has perfectly legitimate reasons to do so as well. So in short, we think that tighter regulations, it should not have a major impact on the long-term growth story of China's technology sector, which is supported by several megatrends. So in the past year, COVID-19 has had a disproportionate impact on the various sectors of the economy, with some more badly affected than others. So airlines, for example, are one of the hardest hit sectors as countries had to shut their borders to prevent the spread of COVID. But in the case of the tech sector, we believe that COVID-19 is actually an unexpected catalyst, one that will likely produce a net positive impact in the long run. So the global health crisis has brought about structural changes to the way we live and work, and with most countries implementing social distancing measures to stem the spread of the virus, physical in-person activities have gradually shifted online, and this drives up demand for digital services such as your e-commerce, cloud computing, digital payments, so on and so forth. So this brings me to my first megatrend, which is the growing number of internet users in China. So between 2019 and 2020, China's internet penetration rate rose by nearly 10 percentage points, which is the largest increase since 2008. So right now, roughly 70% of the people in China have access to the internet. So even though this figure still pales in comparison with developed markets where penetration rates can be as high as 95%, China is already home to 850 million internet users, and that number is greater than the total population of every country in the world, with the exception of India. And as China continues to advance, the number of internet users should rise in tandem, and this should provide tech companies with more opportunities for further growth. So just to give you a better idea of just how massive China's internet space is, have a look at this chart over here. So as you can see, for the various segments, even though China has a lower penetration rate, the number of users still far outweighs the US. And the only segment where China has a higher penetration rate than the US is in mobile payments. So this is because China essentially skipped the entire credit card era, moving from cash straight away to mobile payments. And these days, mobile payment is a widely accepted mode of payment for most merchants, from restaurants to street hawkers. So besides the growing number of internet users in China, another mega trend which we think will propel the growth of its tech sector is the increasingly digitalized consumption habits of its people. So not only is consumption growing, consumption habits have also become increasingly digitalized, where people are more willing to pay for the convenience of on-demand services, from simple stuff like food delivery, ride-hailing, to more complicated things such as banking and travel booking. So today, almost everything can be done online thanks to advancements in technology. So this change in consumer habits, it actually gives rise to many opportunities for companies which are able to cater to them. And within China's vast tech sector, one segment that has benefited greatly from the changing consumer habits of its people is e-commerce. So China, which endured one of the strictest lockdowns in the early days of the pandemic, has seen the sharpest rise in e-commerce activity since 2014, as online sales accounted for 25.2% of the total retail sales in China for 2020, which is about 4 percentage points higher than what it was in 2019. So naturally, e-commerce players like Alibaba, JD.com, as well as many others will stand to gain as this megatrend continues to unfold. And besides e-commerce, the cloud computing industry is also another beneficiary as China becomes increasingly digitalized. With most of the country placed under lockdown, businesses, they actually scrambled to invest in cloud computing infrastructure so that their employees can continue to work remotely from home. And on top of that, the surging demand for online services such as your live streaming, short videos has also contributed to the growing demand for cloud services. And in the fourth quarter of 2020, cloud spending in China reached a record high of $5.8 billion US, which is about a 75% increase from the same period last year. And with cloud computing being a lifesaver for many businesses during this period, we foresee that adoption rates will continue to accelerate post-COVID-19 as businesses rethink the role of technology in their operations. So companies that have temporarily engaged the services of cloud providers during the COVID-19 period are likely to find them useful and end up as long-term paying customers. So all in all, the demand for cloud services, it should continue to grow as China undergoes a massive digital transformation. So to take part in the long-term growth story of China's tech sector, you can choose to invest via single stocks or ETFs. So here are some of our top picks. So first up, we have Alibaba. So in China, e-commerce, it is practically synonymous with Alibaba. But Alibaba is more than just China's largest e-commerce company. It is also China's largest cloud service provider with a market share of about 40%. And to capitalize on China's booming cloud computing industry, the company has actually earmarked about $1 billion US to expand its cloud computing business over the next 3 years. And on the e-commerce front, Alibaba is constantly on the lookout for ways to improve its business. And the company is currently exploring a new format of shopping called live commerce, which combines live streaming and e-commerce. So even though this format of shopping is still relatively new, live commerce has shown great promise so far, and we believe that it will one day become an important component of Alibaba's new retail strategy. And with the recent conclusion of the antitrust probe, we think that the worst is finally behind for Alibaba. And reiterating what I have explained earlier, tighter regulations, they are not meant to stifle the growth of tech companies and thus should not adversely affect the long-term growth story of Alibaba. And due to its recent troubles, Alibaba shares are currently trading at depressed prices. And based on our estimates, we think that at its current share price of about $217 US, Alibaba shares have a potential upside of close to 90%. And given its dominant position in the cloud computing as well as e-commerce markets, we think that Alibaba will likely become one of the biggest beneficiaries of China's digital transformation. Now, should you prefer your investments to be a little bit more diversified, you can also consider the iShares Hang Seng Tech ETF instead. So this ETF, it seeks to replicate the performance of the Hang Seng Tech Index, which consists of the 30 largest Chinese tech companies that are listed on the Hong Kong Stock Exchange. And all these companies, they have high exposure to tech themes such as the internet, cloud computing, and e-commerce. So top 10 holdings of this ETF, it includes names such as Alibaba, Tencent, Meituan, and many more. So we like this ETF because it has one of the lowest expense ratios among its peers, making it a perfect investment instrument for cost-conscious investors. And as we already know, high expense ratios, especially if they are compounded over a few years, they can be a significant drag on return, which is why when it comes to ETFs, we tend to favor the ones with lower expense ratios. And for this ETF, we actually have a target price of about 25 Hong Kong dollars, and that represents an upside potential of about 50%. So moving on, I want to direct your attention to a small segment of China's tech sector which we think has huge potential for growth, and that is its semiconductor industry. So while it is true that China is probably not the first place that comes to mind when talking about semiconductors, we think that investors should actually start paying attention to this segment. So since the very beginning, China has not had a significant presence in the global semiconductor market. In 2019, the country as a whole accounted for just 5% of the global market, which is far behind the US and South Korea, which controlled 47% and about 20% of the market respectively. And the main reason why China has such a small market share in the global semiconductor industry is because of technology. In terms of chip design, China has made significant progress over the years with leading fabless companies like HiSilicon able to design advanced chips that are used in applications such as 5G and AI. And for instance, HiSilicon's new line of smartphone processors is considered to be on par with those that are designed by Apple. Where China is lacking the most right now is foundry technology. So for decades, China has long struggled to produce its own chips, especially those that require a cutting-edge manufacturing process. SMIC, which is China's largest and most advanced foundry, only began producing chips using a 14-nanometer process back in the fourth quarter of 2019, a feat which rival TSMC has actually achieved 5 years ago. And within a short span of a year, this gap has actually widened even further as TSMC introduced its 5-nanometer process in the first half of 2020. And besides TSMC, SMIC's technology is also several generations behind other foundries such as Global Foundries and Samsung Foundry. And despite being the largest electronics manufacturing hub in the world, domestic production only accounts for roughly 20 to 30% of China's total semiconductor demand. Its limited technological capabilities means that China has no choice but to fulfill the remaining demand by importing from other countries, mainly the US. So in 2020, China's chip imports reached a record high of $380 billion US, and that number has been increasing every year as global demand for electronics continues to rise. But with the US clamping down on China's access to these critical components, Chinese companies, they now realize that they can no longer safely rely on imports and will eventually have to start looking inwards to meet their semiconductor needs. So this huge amount of chips that China imports every year is actually a tremendous market opportunity for its local semiconductor companies. And looking ahead, these companies, we think that they will stand to gain thanks to the greater domestic demand and the government's push to localize chip production. So since the US-China trade war began in 2018, the relationship between both countries has deteriorated substantially. And over the past 2 years, this conflict has actually extended to a number of issues that are beyond trade, such as intellectual property theft and national security. But right now, national security, it seems to be the #1 priority of the US government, as it has implemented a string of measures over the past 2 years in an attempt to hamstring the growth of China's leading technology companies, starting with Huawei. So back in May 2019, the US Commerce Department, they actually announced that they have placed Huawei as well as about 70 of its affiliates on the entity list, claiming that the telecoms equipment manufactured by the company can be used for spying, and therefore it poses a national security threat to the US. So this effectively restricts Huawei's ability to purchase vital components such as semiconductors to manufacture its products. And from then till now, many other Chinese companies have actually fallen into the crosshairs of US regulators. And if these companies, they are unable to find an alternative supply for chips, their operations could be severely affected. So in response to this, Chinese officials, they actually began accelerating plans to strengthen the country's semiconductor industry. So as part of its Made in China 2025 plan, China aims to produce about 70% of all the semiconductors it requires by 2025, with a longer-term goal of becoming completely self-sufficient. And given how crucial semiconductors are to a nation's development, we think that the bans will actually have the opposite effect of compelling China to double down on its efforts in building up the semiconductor industry instead of slowing the rise of China's tech sector. So the recent events have revealed China's vulnerability in this key sector, and we think that China will be very keen to fix these issues. Although the road to self-sufficiency will be paved with difficulties, we firmly believe that China will persevere through, as the future of its nation depends on the success of this endeavor. So to help achieve its goal of becoming self-sufficient when it comes to chip production, the government has actually laid out several policies to help the industry. So one of its greatest efforts is actually to set up this national fund to help promote the growth of the local semiconductor industry. So this fund, which was first set up back in 2014, has invested close to $350 billion in various projects and companies within China's semiconductor industry to date. So it is estimated that roughly 70% of the monies from this fund actually went towards the manufacturing firms, and that demonstrates the government's priority of building up the nation's chip-making capabilities. Secondly, the government has also made significant adjustments to its tax policies last year, and that decision should greatly benefit local semiconductor companies. So under the new policy, chip makers that have been in operation for more than 15 years and produce chips using a 28 nanometer and below process may be exempted from paying corporate taxes for a period of up to 10 years. So these tax benefits, they also extend to other companies such as those using mature processes, fabless companies, materials and equipment firms, as you can see from the table on the screen. So the idea here is that by reducing the tax burden, these companies, they actually have more resources to allocate towards research and development, which will hopefully improve their technological capabilities and allow these companies to compete with their global peers. And once again, through the way these policies are structured, we can tell that the government's focus is clearly on strengthening China's chip-making capabilities, which is an area where it is currently lacking the most. So with the motivation as well as the resources to narrow the gap between themselves and the US, we believe that China's semiconductor industry is about to enter a phase of supercharged growth, one that will bring about many investment opportunities in time to come. And investors who are interested in investing in this segment, they can consider SMIC, which is China's largest and most advanced semiconductor foundry. So SMIC is China's national champion in the semiconductor industry, and the company is widely expected to lead the nation's chip-making ambitions. And in 2020, the company's revenue actually rose by 30% on the back of rising domestic demand, which is a trend that is expected to continue as China pushes towards self-sufficiency. And on top of that, SMIC also meets the criteria for preferential tax treatment, which could allow the company to pay significantly less tax over the next 10 years. So the combination of these factors would likely mean that the company will see earnings grow significantly over the next few years. And as we already know, earnings is a key catalyst that will drive share prices upwards. And based on our estimates, we think that SMIC's shares, at this point in time, they have an upside potential of about 40%. And alternatively, investors who prefer a more diversified approach can actually consider investing in the Global X China Semiconductor ETF. So this ETF, it seeks to replicate the performance of the FactSet China Semiconductor Index, which consists of a basket of 24 Chinese semiconductor companies. And this ETF also counts SMIC as one of its top 10 holdings. And besides having a low expense ratio of just 0.68%, another advantage of this ETF is that it provides investors with exposure to semiconductor firms that are listed in mainland China, which shares may not be as easily accessible to certain investors. And to top it all off, using an ETF will also help to minimize any company-specific risk. To sum things up, we think that there are many reasons to be positive about China's semiconductor industry: strong state support, rising domestic demand, and the government's plan to localize chip production are a few factors that could drive an upward re-rating in share prices. And for this ETF, we have a target price of 77 Hong Kong dollars, and that translates to an upside potential of about 20%. And with that, I've come to the end of my presentation today. Here is a summary of all the stocks and ETFs which I have touched on earlier. I hope that through this session, you have been able to gain a better understanding of China's technology sector, its prospects, and most importantly, why we think it is a good investment at this point in time. Once again, my name is Terchin. Thank you all for being here today, and I wish you all the best in your investing journey.
Hi everyone, good evening. My name is Xingyan and I'm from the Unit Trust team. And today I'll be sharing with you the top 5 funds to invest in the second half of 2021. So 2021 has actually been a decent year thus far. And with the US markets leading the way, global equities are at their record highs, driven by the improvement in vaccine deployment worldwide. In the second half of 2021, if vaccine deployment continues to go smoothly, we should be entering a distinct post-pandemic era, and hopefully we are at the beginning phases of a new normal. However, a new normal has its economic implications as well. With strong economic data coming in globally, and inflation looming large, an unwinding of crisis relief measures is likely to happen sooner rather than later. The current low interest rate environment is unlikely to persist for much longer, and with the Fed indicating as such, investors should start positioning their portfolios accordingly. In the first half of the year, the winner was undoubtedly value stocks as they bounced off their pandemic lows. While growth faced headwinds in rising rates, values remain largely untouched, with some sectors such as financials actually benefiting from this. So moving on to the first fund that we would like to highlight. The first fund that we would like to highlight is the Allianz Global Opportunistic Bond Fund due to its strong risk management characteristics and low correlation to equity. The fund is an unconstrained bond fund, and it differs from traditional bond funds as they do not follow a bond index. So this allows the fund to exhibit higher flexibility within their asset choice decisions. So for most investors, fixed income portfolios should achieve the goals of stable income and low risk to principal. And the current interest environment of rising rates and low use makes these objectives very challenging to achieve. A higher flexibility in their asset choice allows for better duration management and reducing the interest rate risk. So what makes this fund attractive is its above average risk management characteristics. Its maximum drawdown across the last 3 years is negative 3.5%, which is excellent considering that we have had 2 big shocks for bond markets during that time. So this drawdown occurred during March last year as the pandemic forced the world into shutdown, and even when rising rates caused a bond market sell-off earlier in 2021, the fund remained resilient. And this is perhaps a textbook example of how unconstrained bond funds can help mitigate interest rate risk. In addition, its low correlation with global equity in general makes it an excellent complement to equity positions in your portfolios, and making this a very good diversification choice. Moving on to the second fund, we like the Fidelity Sustainable Strategic Bond Fund. So the fund's overall strategy is quite similar to the recommended fund on our platform, which is the Fidelity Global Bond Fund. But there are some slight nuances in strategy that make it a more attractive tactical play at this point in time. So firstly, the fund has a lower duration, making it less sensitive to rising rates, which is very important to consider. Secondly, the fund's ESG exposure makes it an attractive choice. ESG fixed income has lagged behind ESG equity counterparts, but 2021 should prove a big year for the sector. We expect to see record ESG bond issuance this year, which should increase the investment universe for the fund, giving them more asset choices to construct a profitable portfolio. We also expect to see further fund flows into the sector as ESG becomes a key decision factor for many large financial institutions. So these factors combine to help the fund maintain its strong performance. However, it is worth noting that the fund is more aggressive than both the Fidelity Global Bond Fund, which is our recommended fund, as well as the Allianz Global Opportunistic Bond Fund that we highlighted earlier. However, we believe that it is still a very attractive tactical play for the second half of 2021. So now we'll move on to the third fund and the first of our equity picks. We have the Schroeder ISF Latin America Fund. So the fund was one of our favorite picks for the first half of the year and one of our top performers in the quarter that just ended. And in the second half of 2021, this region remains one of our favorites. And this is because of a combination of very strong underlying factors. One of the region's core economic drivers is its commodity exports. And with the ongoing boom in global demand for commodities, export numbers should remain high. So some of these key export drivers are structural in nature, including the various infrastructure plans put forth by governments worldwide, such as the US and China, as well as the ongoing electrification leading to strong demand for industrial metals. Combined, these factors should continue to support commodity demand, of which the region is a key player. In addition, USD weakness in the longer term should benefit this region more than most. The LATAM region has notoriously high levels of USD-denominated debt, and USD weakness should help to ease some of its repayment stress. The weaker USD has also been traditionally supportive for commodity prices and should prove supportive for the commodity-dependent region. Finally, we expect pandemic-driven issues to ease as vaccination rates pick up outside developed markets. So some of these EMs, particularly Brazil, finally have access to vaccines, and this should slow down some of the pandemic concerns that have weighed down the region in the past 18 months or so. A reopening of the region, and tourism in particular, is a cherry on top of an already compelling idea. Our fourth fund is the UBS Greater China Equity Fund. So, as my colleague Te Chin has mentioned earlier, the rise of China cannot be understated, and the economy is on track to become one of the world's biggest by the end of the decade. While the Chinese government tech crackdown seems relentless and never-ending, we believe that this should be constructive for the market in the long run, with the government removing much of the excess valuation. In addition, China's first-in, first-out situation regarding the pandemic has led to its underperformance in the first half of 2021, with it being one of the first economies to withdraw some of its COVID-19 crisis measures. As the developed markets start to follow suit, China should appear relatively more attractive, especially at current valuations. So this fund is held by one of the most experienced fund managers in Binshi, and we believe that the fund's focus on quality and long-term growth should position them for success for the second half of 2021 and beyond, even if regulatory risks continue to persist in the near term. We also opt for a Greater China approach for some additional semiconductor exposure through Taiwan. Finally, the last one for the evening is the BlackRock Next Generation Technology Fund. So disruptive innovation has had a shaky start to 2021, and the investment team's long duration nature and high valuations makes it particularly vulnerable to inflation and rising rates. But despite these near-term challenges, we think the theme is too important for investors to ignore. With technological changes happening faster than ever, investors without exposure to tomorrow's winners risk being left behind by a rapidly changing world. So why do we like this fund? Firstly, when it comes to disruptive innovation as a theme, we believe that diversification is key. The success of the strategy should not be reliant on concentrated bets in a select few companies, but the contrary. In addition to being a more fitting strategy for the team, it also helps to significantly improve some of the risk metrics and more than justifies some of the trade-off in returns that the fund gets. So we think that identifying tomorrow's winners is ultimately a numbers game. It is no secret that many innovative tech firms and startups in their early stage of growth tend to go bankrupt over time for a variety of factors. Yet all we need is a handful to become the next Google, the next Apple, the next Tencent, and the investment will have paid itself back multiple times over. Thus, we think diversification via less concentrated positions is an important attribute to consider for these higher risk equity funds. And this fund provides just that. Its portfolio spread across 80 to 120 companies, and each open position is currently below 2%. So it certainly provides diversified exposure to tomorrow's potential winners. We also like this fund for its more balanced geographical exposure. We believe that innovation is a global theme, and the fund is very diversified globally, with more than 45% invested outside of the US. So markets outside the US are also typically more challenging for investors to access. This is due to investors having less available information and often coming at the cost of higher fees. For example, for most of the markets in Korea or Japan, you have to make a phone order via phone, and normally this leads to higher fees. So the fund provides a fast, free, cost and time-effective method of investing in these assets, leveraging on the size and expertise of BlackRock's experienced research team. And this has paid off handsomely. The fund has registered comparable volatility to most tech funds on our platform, despite not investing in many of the tech giants such as your FANG stocks. It has also outperformed these funds on a one-year basis, despite being theoretically more vulnerable to the current macro environment. So undoubtedly, disruptive innovation is a highly exciting theme, and we think any long-term portfolio could benefit from having exposure to it. But as exciting as it is, we would also like to highlight that much of today's innovations are also driven by today's tech giants, not solely by disruptive innovators. Hence, in a growth-centric technology portfolio, having balanced exposures between these tech megacaps and these thematic funds or ETFs is essential. Ultimately, we believe the Next Gen Fund plays a strong complementary role to the OGIC Fund as well as the BlackRock World Technology Fund due to its geographical and size approach. Having exposure to both will provide investors with a portfolio that is well positioned to capture future growth opportunities globally. To sum it up, as we step into a post-COVID era, it is time to focus on quality and fundamentals. As liquidity is slowly reduced, not all assets are made the same, and hence not all assets will react the same way. Investors looking for quality and strong underlying trends should look into these funds, as we think that they are positioned to take advantage of these trends in the second half of the year. Thank you.
Hi, my name is Dexter and I'm a senior fixed income analyst. Together, my team and I actually help to provide research ideas on bonds. So for the next couple of minutes, I'll be telling you why you should anchor and diversify your portfolio with these fixed income ideas. So for the next, for this presentation, if you forget anything, just remember these key points. Fixed income is added to a portfolio as a source of diversification to help reduce your volatility and portfolio risk. Second, Bond Express, which is available on FSM1.com, allows investors the ability to trade bonds in smaller lot sizes. So no doubt, as my colleagues earlier has highlighted, interest rate hikes will cause bond prices to fall, but overall we adopt a bottom-up approach to securities in credit selection, and therefore we still maintain our positive outlook on certain bond issuers in the real estate and commodity sectors. So diversification is actually a very powerful concept in finance. So if you want to improve your risk-adjusted returns, you can actually add bonds to a portfolio of stocks. So to illustrate my point, here we have, for example, if you bought a portfolio of stocks and the performance of the portfolio would naturally mirror the EEM ETF, which is the emerging market ETF. So this is shown by the black line, and you can see from 2010 to 2021, the performance of the portfolio has dropped. I mean, there were drawdowns whereby there were like more than 30% drawdowns, particularly in the period from 2014 to 2016, or in between 2018 and 2020, where there were more than 30% of drawdowns. In comparison, we have the performance of the maybe a single bond like the STSP 7.375% 2031 bond, which is issued by Singtel, which is an investment grade issuer. So if you look at the blue line and the black line, you can tell that the blue line has a much lower drawdown. And in fact, in some periods, it outperformed the EEM ETF. So for example, in 2012, the blue line outperformed the black line, and maybe in 2016, it also outperformed the emerging market ETF. So clearly, there are some benefits to adding bonds to your, if you have a stock portfolio. So if you allocated 50% of your capital to a single stock and the other 50 to the EM ETF, you would have a performance quite close to the gray line. And you can see that the drawdown of the portfolio has been mitigated. So by this way, you're able to sleep better at night and maybe make better investment decisions. So if you're new to bonds, you can actually explore fixed income investing through Bond Express, which is on FSM1.com. So Bond Express actually allows investors to buy bonds in smaller lot sizes. So you can log in into your account and then you can look at invest, and under you can search for Bond Express, and the list of bonds will be shown here in this list. So you select from the list of Bond Express bonds, and you can create your own portfolio using Bond Express bonds. So there are two options for you if you have like 250,000. So you may either invest 250,000 in a single bond, or you can invest 250,000 in a portfolio of Bond Express bonds. So as mentioned earlier, Bond Express bonds are available for as low as $5,000. So, but one thing about Bond Express bonds is that these bonds are closely followed by the team, and but we also have positions in these bonds, so your interest is aligned with us. So just to give you introduction of the naming convention of bonds on our platform, here I've shown an example of LVGEM 12% 2023 bond. So the ticker is LVGEM, so that's the first word of the bond, the naming convention, and then followed by the coupon rate, and then thirdly we have the bond maturity date. So in this example, the bond matures in March 2023. So if you want to buy the bond, you can do so on fsm1.com. You can purchase it at the indicative ask price, and if you bought it at 102.1 on 2nd of July, you would have a ask yield to maturity, or the gross annualized rate of return on the bond if you hold it to maturity, of about 10.57%. So one of the questions that I'd like to address is that what happens to fixed income securities if interest rates move higher? So this was highlighted earlier by the panelists. The short answer is that bond prices will fall if rates go up. Fixed maturity bonds and perpetual notes will be impacted by imminent rate hikes. So perpetual notes would be something like bonds with no maturity dates, but instead the issuer has the option to call these notes on their call dates. So within the context of perpetual notes, we think that those with no reset rate references will be most affected by interest rate movements. So what are some examples of perpetual notes with no reset rate references? So one example is the Li & Fung 5.25% perpetual US dollar note. You can tell that this doesn't have a reset rate reference just by looking at the field over there. It's blank, so there's no reset rate reference. So historically, this bond, if we look at the performance during 2017 to 2018, the bond has dropped more than 30% in the midst of rate hikes. So the Federal Reserve was actually increasing interest rates from about 0.25% to about the range of 2.25%, and the bond is very sensitive to interest rate movements, and it has dropped by more than 30%. So there are also other examples of bonds with no reset rate references. For example, the 7.25% issued by Banco Santander Brazil, as well as the 4.5% HKI BHK. So interest rates may go up, but not all perpetual notes will be impacted equally. So here I plotted the modified duration of individual fixed income securities versus their Z-spread. So there are some notes which would be more affected by rate changes and will be more sensitive, and there are also other perpetual notes which will be less affected by interest rate changes. So the ones that I've highlighted here, so the ones which will have higher modified duration, like the AIA 2.9% perpetual note, or the STSP 3.3%. So these notes are callable in 2031, which is why their duration is high. And just to illustrate what it means, for example, the HKI BHK 4.5% perpetual has a modified duration of 20. What this means is that if interest rates move by 100 basis points, you could see potentially the price drop by about 20 percentage points, or 20 cents on the dollar. So on the other hand, we have other notes, for example, the 6.6% or the 7% perpetuals that are issued by LMRTSP, which is Lippo Malls Indonesia Retail Trust. They would be less affected by interest rates. The reason being is that these notes are already trading at a very depressed price. So if there's any interest rate movement, they would be less sensitive to interest rates. So we adopt a bottom-up approach to fixed income selection. So no doubt interest rates may affect the broader fixed income market, but however, there are still some mitigating factors such as the reset features that are found in most Sing dollar perpetual notes. So in this example, I'll be showing the OLAM 5.375% perpetual note, and you can tell it has a reset rate reference just by looking at the box over there. This note is callable in 18th of July 2026, and it pays a coupon of 5.375%. So if the note is left outstanding on 18th of July 2026, the coupon will change from 5.375% to the prevailing 5-year swap offer rate plus 4.8% plus 2%. So as you can tell, if interest rates were 0, meaning the swap offer rate is 0, the minimum reset rate will be 6.8%. So the rate will change from 5 to a minimum of at least 6.8%. So this is actually attractive from the investor standpoint if Olam still maintains a credible credit profile. So if interest rates were 1.2%, then the reset rate will be 8%, which is much higher than the 6.8%. So moving on, we like certain issuers for the second half of 2021, and our approach is always from a bottom-up approach. So these would be some of the real estate and commodity issuers. These are bond issuers. So real estate and commodities are actually real assets with tangible intrinsic value with substance and physical properties. So in an environment of high liquidity, there will be real asset demand, and bond issuers will do well because they have a good ability to pay down their bonds and at the same time providing a good yield to their investors. So within real estate, there's Chinese real estate, which is an integral part of the Asian high-yield fixed income market. So why Chinese real estate? If you look at prices, property prices in China on average have been nearly doubled from 2015 to about 2021. And not only that, mortgage rates also have been falling. And at the same time, disposable incomes in China are also improved, and property is seen as a prestige symbol in China, and that's why we think that there will still be demand for real estate, and Chinese real estate issuers will do well. One of them is LVGEM, Real Estate Investment Company Limited. So this is actually a small property developer with a narrow geographic focus in the Greater Bay Area. For those of you who are familiar, is with it along Macau, Hong Kong, and Guangzhou. So it's a quality land bank, and with about 6.48 million square meters of land reserves, 80% of which are located in Shenzhen, Hong Kong, Zhuhai, and Dongguan. So one of the driving force for this bond issuer is that it was awarded the Baishizhou Urban Renewal Project in Shenzhen, which could potentially provide up to about 200 billion RMB of attributable sales to the group in future. So this is arrived by multiplying the site area of 3.48 million, multiplying by the Shenzhen sales of about 120,000 RMB to 150,000 RMB per square meter. And that's how you get 200 billion RMB. So it's clearly a big contributor to its issuer profile in future. So historically, this issuer has also done well. If you look at revenue and profits are also increasing. So the company actually aims to have a sales target of about 6.5 billion for this year. And if you look at the credit indicators, net gearing has improved from 135% to 76% in 2020 from 2019. Cash to short-term debt ratio has also improved. Liabilities to asset ratio has dropped from 70% to about 60%. So given these three indicators, we can tell that it's actually a yellow light developer, meaning can actually increase its debt by about 10%. However, average borrowing rates have increased from about 6.3% to 7.1%. But overall, if we look at its sources of liquidity, the company has about 23 billion of investment properties that it may monetize or even divest some of its properties held for sale, or even access its banking facility of 20.7 billion to pay down its current borrowings. So its borrowings are about, its current borrowings value as of 2020 is about 10 billion, and then we have the non-current borrowings. So collectively, the columns on the left, the values of the columns on the left exceed the values of the total columns on the right. So given its adequate credit profile, we'll be recommending the LVGEM 12% 2023 bond, which is also on Bond Express. The bond right now is trading at about 100.5 with a yield to maturity of about 11.4% if you bought the bond at 100.5. So within the Sing dollar space, we like ESR Cayman, which is a leading manager, investor, developer of logistics real estate. So as of 2020, it has about 29.9 billion of assets under management, and with about 7.2 billion square meters of GFA, gross floor area in the development pipeline. So there are three main business segments that contribute to this company's EBITDA. Collectively, these three business segments, the investment segment as well as the fund management segment, and then we have the development segment, is seeing a strong demand from e-commerce players. It has a high portfolio occupancy rate of 90%. And some of its tenants will be Amazon, Coupang, JD.com. So it's also a fund manager of logistics real estate, and its AUM is growing. And not only that, some of its institutional investors who have invested in its funds include GIC and Ping An. And collectively, these three segments provide EBITDA, like I said, about 663 million, and its total core PATMI, which is profit after tax, including minority interest, is about 200 plus million. So this issuer has a well-capitalized balance sheet, and this is good for bondholders. Net debt to equity is healthy at net debt to total assets is healthy at 23%. Net debt to equity is about 46%. So something below 100% would be adequate in our view. Average borrowing cost is about 4.6%. If you look at its balance sheet at the end of 2020, it's about 1.5 billion of cash that will exceed its current borrowings about 700 billion US dollars. So we'll be recommending the ESR 5.65% perpetual corp, which is also available on Bond Express. The yield to call, if you bought the bond at 100.15, is 5.59. So this is a perpetual note. Again, it does not have a maturity date, but instead the issuer has the option to redeem this note when it's callable in March of 2026. So just for reference, the reset rate reference is the 5-year swap offer rate, and with an initial spread of 4.73 with a step-up margin of 200 basis points. So the minimum reset rate, if it's left outstanding on its call date or reset date, will be 6.73%. So the coupon will change from 5.65 to about 6.73%. So this is attractive, provided that the issuer still maintains its credit profile. So within commodities, we like Olam International. Olam, I think, is a familiar name among us. It's a global supplier of raw and processed agricultural commodities. It operates in 60 countries, providing goods, foods, ingredients to over 25,000 customers. It's one of the largest companies listed on the Singapore Stock Exchange by market capitalization. Temasek is a large shareholder of the company, and not only that, Mitsubishi Corporation has also a stake in the company. So with these two large shareholders, we think it has good access to the capital markets. So when it has good access to the capital markets, it may use that to refinance or pay down its borrowings. As some of you may know, agricultural prices have broken out. This is a chart of agricultural prices from 2016 to about 2021. Recently, prices have broke out from a range, and we think that agricultural companies would do well because they are benefiting from these high prices. If you look at, you read the news, you can tell that there are disruptions in weather, there are floods and droughts, and this has, at the same time, there's food hoarding, and this created a demand for agricultural. So if you look at cocoa prices, cotton prices, and coffee prices, Olam is actually a leading supplier of these three agricultural products. They have also gone up, and this will be beneficial for Olam. So Olam, its business performance has been pretty well. If we compare the first quarter of this year compared to the first quarter of last year, we see that revenue has improved by 14.5%. PATMI is about 155 million. Operational PATMI, which excludes exceptional items, which are 157 million. So the company has a high gearing, but has adequate sources of liquidity that are available. The net debt to equity before fair value adjustment is about 172%, so that is actually high. But if we look at adjusted net debt to equity, which will adjust for secured receivables as well as readily marketable inventory, the net debt to equity on an adjusted basis would drop from 172 to 50% as of March. So looking at these sources of liquidity that it may use to pay down its borrowings, you can tell that there are various sources of liquidity that's available. For example, they can actually liquidate their inventory, so their inventory would naturally be made up of commodities, so there's about 8.4 billion of them. Then at the same time, they can also utilize their credit facility, which is about 6 billion, or even tap their cash position of about 3.8 billion that it may use to pay down its capital, its perpetual notes, or its current borrowings, or its non-current borrowings. So we are recommending the OLAM 5.375% perpetual note Sing dollar. It has a current yield to call of about 5.28%. So that's on an annualized basis until July of 2026. So I shown this earlier. The reset reference rate is the 5-year swap offer rate plus 4.8% plus a step-up margin of 200 basis points. So the minimum step-up is the minimum reset rate if the note is left outstanding is 6.8%. So in summary, investors actually include fixed income in their portfolios as a source of diversification to reduce volatility and portfolio risk. Bond Express, which is available on FSM1.com, provides investors, especially if you want to get a feel of the bond market, to the ability to trade bonds in smaller lot sizes. And no doubt, interest rates may increase and bond prices may fall. However, we take a bottom-up approach. We look at individual fixed income securities. We look at their abilities of the issuers to call, to pay down their notes. And then we look at the terms of the notes. And we still maintain a positive outlook on certain issuers in the real estate and commodity sectors. So with that, I thank you for your attention, and I've come to the end of my presentation. I wish you all a successful second half of 2021, a successful investment period for the second half of 2021. Thanks.
Good evening, ladies and gentlemen. Thank you for taking your time to join us here at the mid-year review event. I'm Ziyang, portfolio manager for the MAPS portfolios. And I'll be wrapping things up for the last segment of today's event. I'll start by doing a recap of all the great ideas that have been presented by the presenters before me, and then share how can all these investment ideas be put together for investors to then position themselves for second half of 2021 and beyond that. So without much further ado, I'll start by discussing where we are in the economic cycle. This is the same exact chart that we show you at the What and Where Invest event at the start of the year, where we were at the early phase of expansion. Fast forward, 6 months later, what we are seeing is that global economic cycle is now stepping into the mid-cycle of the recovery phase for the second half of 2021. And that kind of mid-cycle recovery could potentially extend beyond 2022 or even 2023. So one easy way to gauge where we are is actually simply to look at the global PMI heat map. For investors who are not familiar with this, PMI stands for Purchasing Manager Index. It's a monthly survey of a diverse range of industry in each economy, and it's actually commonly used by analysts and economists as a leading economic indicator. So taking a glance across the charts, you can see that things have improved significantly since the reddish part in the first half of last year, which is sort of the trough of the economic cycle. And since then, some economies are ahead of the broad cycle, such as China, which recovered first in May 2020, followed by the rest of the world in July and August. But since then, we have actually moved at the start of the year, we have actually moved into the kind of early recovery phase. And the global economies have actually, even under that kind of shadow of the pandemic, we have started to recover. It doesn't feel that way for Singapore because we are still stuck in that kind of semi-lockdown phase. But if you look into the US and look at Europe, in fact, for US, things are already reopening. So I think if you set your sight further ahead, you can see that the rest of the world will gradually reopen to travel. And you never know, maybe by next year, or we can actually see international travel start expanding and travel bubble to become a real thing. And interestingly, if you look at it, China has started to slow down just about 2 months ago. So is this an early sign that the rest of the world is about to follow, just like they did at the start of last year? We think this is actually a possibility. And after all, the global economic cycle is now heading into the mid-cycle expansion. And the speed in which it got from recession to recovery to early expansion has actually been the fastest in modern history, in just barely 1 year time. And as you can see for the chart on the right, all major economies are expected to see a sharp rebound in GDP growth this year. This is partially helped by the fact of the rising vaccination rate, falling COVID case count globally on an aggregate manner. The cautious reopening in parts of the world, say in US, has already happened. For Europe, yes, I think the Delta variant is kind of delaying some reopening efforts, but I think maybe after this summer, things will start to die down, and as vaccination rates start to pick up, Europe could actually potentially open for good, and followed by parts of Asia and the rest of the world, despite that kind of on and off outbreak due to the more infectious variant. But I think the key reason why we saw a rapid recovery was also due to the massive fiscal stimulus globally and the ultra-accommodative monetary stance by major central banks across last year to this year. However, as we head into the mid-cycle expansion, such policy can have a different effect on the economy. As in the previous panel discussion, our macro analysts did share about how the rising rate environment, we can expect the rising rate environment ahead. And while a lot of this expansionary stimulus has been quite helpful during periods of downturn, it can actually be a double-edged sword when things start to recover and economies to restart strongly. And one of the impact is really felt in inflation. And over the last 2 months, within the US itself, we have seen inflation surging across April and May, as seen on the chart on the left. And a major part of this inflation is due to base effect, transitory factors. And according to the Feds, that was their story as well. The surge is due to prices of suppliers and businesses suddenly need to adjust to the sudden outburst of pent-up demand. But if you break into it, you can see that inflation could be actually stickier than expected and may not go away as quickly as what Fed has predicted. In fact, some of their recent tone after inflation started picking up seems to be acknowledging that they could be wrong with their transitory inflationary theory. And as such, we like to think that the likelihood are increasing that we will see a reversal in that kind of low interest rate environment sooner than expected. So while Fed still maintain that the first rate hike will only come in late 2023, we disagree, and we like to bring forward the timeline to as early as next year. In fact, we now expect somewhere between 3 to 5 rate hikes by the end of 2023. Investors should not be surprised if there's actually even more rate hike than what consensus currently expects. especially if inflation continue to stay high for a longer period of time. And also given the fact that investors tend to be forward-looking, they will actually price in the kind of tightening environment ahead, which will have a serious implication for assets ahead. And I think if you look across the wide range of assets like your equity and fixed income, you can see that equities right now are trading close to the top of their historical PE valuation, partially driven because of the flush liquidity unleashed into the economy last year. And of course, like we discussed in the panel discussion, it has actually materialized into that kind of greater full investment strategy within your crypto space as well as your meme stock space. And comparing between the major economy, you can see that the developed markets are a lot more expensive. In fact, valuations of developed market versus emerging market has widened significantly this year. Hence, the impending reversal of the low interest rate could actually affect these high PE assets badly. And we see the same scenario panning out for your global fixed income market. Credit spreads across bond categories have compressed significantly since last year. Yields are now hovering near their lowest point within the last 5 to 10 years. I think one segment that Weiren in the panel actually pointed out similarly to what I have saw is that it's quite worrying for the US high yield bonds, which are now actually offering just yields of about 3.8%. And if you look at the chart on the right, you can see that the kind of yield, 3.8% yield, is that typical of the safer credit investment grade bonds in the last 5 years. So, and it's also, right now, the credit spreads and the yield levels are also now at a record low for US high yield. And looking ahead into this transitory period of this economic cycle, the mid-expansionary territory, we mean that liquidity will likely to become tighter soon. As we have discussed in the event earlier during the panel, as rates rise, the kind of pump and dump, greater full kind of investment scheme will be challenged, which also means that investors who are buying into market highs, hoping for momentum to bring them even further ahead, could be in for a rude awakening. And there will be no more fools for you to pass your hot potato at that point of time. Therefore, we believe it's our duty to sound out the cautionary bell on such speculative strategy. Valuations will start to matter again, and investors need to position themselves, reducing exposure to the more speculative, greater full assets, and focus on products with quality and fundamentals, assets which have intrinsic value and will therefore be more resilient to downturn. And I think in my previous past speaker, they actually shared a lot of value opportunity. As a roundup, I would like to summarize and recap for you guys as well. So the good news for investors at this point of time is that there's actually plenty of value opportunity out there for investors to make the switch. In my panel discussion, I pointed out the 3 baskets, which is your classic value, your undervalued assets, as well as your high quality growth. So over the next few slides, I'm going to elaborate further into what each of these baskets signifies and what are the products that investors can choose to get exposure to these baskets. So first up, we have the classic value stocks. So value stocks tends to outperform growth historically during a higher inflationary period, simply due to their low duration nature. So global financials is one such classic value sector. Banks and financial services will benefit greatly from the improving growth backdrop. They will see their loan growth starting to rise, and the kind of steepening yield curve due to rising rates will also help boost their net interest margin, which is a huge part of how banks make their profits. And as a result, the combination of both, we will see actually strong earnings growth due to that healthier balance sheet. And as growth, the environment start to move away to an expansionary phase from the recessionary environment, the kind of loan loss provision that they were forced to take up by the governments, it will start to recede. And they will be able to release some of that extra cash to their investors, So at this point of time, investors can actually consider our recommended fund for financials, which is BlackRock World Financial Funds, Or if investors who want to get exposure to this using an ETF can get the recommended ETF, iShares Global Financials ETF. The second would be more of a geographical exposure. That would be Europe. Europe is another classic valued play. Europe has the highest exposure to value sectors like your financials, your industrials, and your healthcare, which accounts for close to half of its index. And I think one thing for Europe is that is actually quite appealing on a valuation end. Yes, cheaper PE valuation against its other developed market peers like US and Japan. And for that, investors can consider our recommended funds for Europe, which is Allianz Europe Equity Growth Fund. The second basket are the undervalued assets. In fact, we think that undervalued assets are not isolated purely to value stocks. Value assets can be found in any assets that are trading below their intrinsic value. At this point of time, we see the undervalued asset being majority in mostly in the EMs, particularly within the Asia as well as the Latin America space, which have largely lagged their developed market peers, which lead to some form of a deepening valuation discount versus those developed market peers. But I think it's also important to point out the fact that rising vaccination and falling the COVID cases within the EM space itself, although at this point of time they're probably struggling with getting vaccine supply. But as vaccinations start to inactively start to close out, these regions can actually close out the kind of performance gap. And valuations are actually relatively cheap now, providing investors an opportunity to buy in for the eventual performance convergence. And the two notable products that we think investors should take a closer look is the UBS Equity Greater China Fund for your Asia exposure, and your Schroders Latin America Fund for your Latin America exposure. These are also the two funds that our UT analyst, Jing Yan, has presented just now, and it's among the top 5 funds that we think investors should consider for the second half of this year. Last, but definitely not least, our last basket is into that kind of high-quality growth assets. At this point, you must be wondering, like, aren't growth stocks sort of the polar opposite of value? To that, we politely disagree. We think that there are value opportunity within growth as well. So a lot of your global high-yield, high-quality growth stocks like your mega cap tech company, your Facebook, Alibaba, your Facebook, Apple, Google on US side, and your Baidu, Alibaba, Tencent, Meituan in your US side, in your China side, is one segment. Not only are they the prime beneficiary of the kind of long-term structural tailwind due to COVID, such as your digital economy, your remote working trends, they also have very strong balance sheet and stable cash flow to withstand any macro or pandemic kind of uncertainty that may prop up in the second half of this year. And another notable segment that we have seen is the China tech giants. We saw a window of opportunity at this point of time to accumulate them at a cheaper price after the recent sell-off. While I think the regulatory risk at this point of time could continue to persist longer than expected, we think that the healthier fundamentals could actually ease investors' pessimism, which we think investors are quite pessimistic on that sector at this point of time. So within the high-quality growth segment, we saw 4 distinct segments for exposure. First is the US China Semiconductor, the ETF that Dejun, our ETF analyst, has shared about in the kind of about in terms of merits for the Global X China Semiconductor ETF. And the second one is also something that Dejun has suggested, which is the iShare Hang Seng Tech ETF and Alibaba in his presentation. And the third one would be the Global Internet Mega Cap, which we think investors can consider one of our investors' favorite, which is the OGIC ETF. And last but not least, the 4th segment is into disruptive innovation. And this is a fund that our UT analyst, Jing Yan, has actually presented on just now, which is the BlackRock Next Gen next-gen technology fund, which actually invests into the smaller cap, tomorrow's winner, which we think at this point of time, investors can also get exposure if they are looking further ahead as things start to normalize and growth to start to be more sought after. So after a summary of the key ideas shared across this presentation, you must be wondering how can we incorporate all these ideas into a real-world investment portfolios. And over the next 2 slides, there's two ways you can do it. One way, first of the 2 main actions we believe our investors need to do for their portfolio simply is to do a portfolio rebalancing. With equity performing significantly better than our fixed income, especially the developed market ones, allocation in your portfolios, if you have rebalanced at the start of the year, would have likely drifted far away from your target allocation. This also means that your portfolios are now exposed to even higher risk than you may be comfortable with. Therefore, the first and most important things you can do for your portfolio is simply to rebalance your portfolio back to their intended weight, taking profit off the winning position and adding them into that kind of value opportunity. Which brings me to the second things that you can do, which is to do some tweaks to your asset allocation to better position your portfolios for that rising yield environment, the tightening credit environment ahead. And this is how we would like to position the different ideas we have presented within a portfolio format. We will overweight the kind of undervalued opportunity at this point of time within EM, especially Asia and Latin America, as well as some selective fixed income exposure via your Asian high yield, where yields are decently high as compared to its peers. We will place the classic value segment, like Europe and financials, into the neutral segment, given that they are already performed quite well to date this year. As for the high quality growth opportunity, at this point of time, we'll hold them at an underweight position. But the important point is that we still have exposure to them, just a smaller one. And if growth stock continue to correct as rate hike fears as the kind of fears over rate hike start to materialize in the market, we think investors can actually gradually accumulate them at a lower price ahead and bringing that undervalued position up to neutral or even an overweight position. For your MAPS portfolio holders, you don't have to worry. You don't have to lift a finger to do all the portfolio rebalancing and tweaks to your portfolios in the second half. That is what I'm here for. As your manager, I will implement the kind of changes and rebalancing of the portfolio on your behalf. I'll be making three main actions for the portfolio ahead and for the second half to better prepare them for the year. First, I'll trigger a rebalancing over the coming weeks. So during the rebalancing exercise, I'll also be making a bit of allocation adjustments as discussed just now. For equities, this means that we will maintain the kind of moderately risk on, especially within the undervalued segment. And this has served us quite well across the first half of this year. For the fixed income segment, the exposure will be more defensive to kind of cushion the portfolio for any potential shocks ahead, especially depending on how market participant reacts to that kind of tightening environment. Last but not least, we'll also be doing some fund switches for the underperforming funds, and the new incoming funds will be a lot more resilient and also more closely aligned to our recommended funds from our research teams. So this is how the asset positioning will look like after the changes. On the inter-asset allocation, we'll maintain the kind of 5% equity overweight, simply because we think that the kind of improving growth environment, regardless of that rising inflation as well, will actually be more conducive for equity. And with the fact that fixed income at this point of time, yields are really quite low, and rising yield environment will see negative hit in terms of price for bonds. But on the intra-asset allocation, that is where we express our views more distinctly. We'll maintain the kind of moderately risk-on exposure towards the undervalued EM as well as equity assets, while keeping a slight underweight on your developed market peers and more growth-oriented assets. We'll also be providing a lot more updates with regards to those changes and portfolio performance in the upcoming week. So for your MAPS holder, do stay tuned. So for my final segment, I'll do a shameless plug for the MAPS, FSM MAPS managed portfolio, especially for those who are unfamiliar with this product. So your FSM MAPS portfolio is an online managed portfolio service that builds and monitors and rebalances your portfolio for you without you having to lift a finger. This portfolio are a fast, free way of investing without having to go through all the tough work of having to do your own research, pick your own product, and then finally manually do your adjustments for your portfolio. MAPS simply does it all for you on an ongoing basis on your behalf. So, and the MAPS portfolio, the good thing is that it's meant for everyone, especially investors who are unsure when, where, and how to start investing. Another key selling point we have for MAPS is also for investors who have a small amount to invest in, but wish to invest in a globally diversified manner. Because MAPS actually lower the barrier to entry for investing with a minimum sum to invest at $1,000, $500 to top up thereafter, and you actually get a globally diversified portfolios with ongoing monitoring and rebalancing at a low management fee. And for the MAPS portfolio, there's actually 5 main portfolio types for investors with different risk tolerance, all the way from conservative to moderately conservative, balanced, moderately aggressive, and aggressive. The key difference is that in the asset allocation mix based on principles of the modern portfolio theory. MAPS holders also have the option to switch between portfolios of different risk profile types, as and when you opt to risk on and risk off, depends on your take of the market ahead. So here's how the asset allocation mix will look like for a balanced portfolio across. As you can see, it's balanced across fixed income, equities, as well as tactical ideas such as financials and semiconductor, which we think can outperform in this very current juncture. And in each of these categories, we maintain a varying weight to each geographical segment and product segment based on a research core across our entire global research team. And the most important point is that while we can express our overweight and underweight preference based on the backdrop ahead, investors will still get some exposure to different markets and assets at any point, enabling investors to reap rewards of market returns at all times. Right, with that, I've come to the end of my segment, as well as the end of the FSM mid-year review event. Thank you for thank you for attention and for staying all the way to the end of this event. We hope that the presentations tonight will be helpful in providing you with some guidance in managing your portfolios for the second half of 2021. If not, here are the main takeaways for you. First, rebalance your portfolio for the second half of this year, especially those who have yet to touch the investment since the start of the year. Your portfolio weights would have drifted away. Second step would be to start reducing exposure towards the speculative assets such as your meme stocks and your cryptocurrency, and add exposure to your quality assets with fundamentals. We think that moving ahead, the conditions will be a lot tougher and more challenging for a lot of your speculative, greater full pump and dump assets. And finally, if you have any questions, feel free to send them in to us using the Q&A function on the Event Live portal, and we'll be responding to them as soon as we can. As usual, continue to stay tuned to fsm1.com. There will be even more events ahead in the second half of the year, where we will continuously share more the latest investment insights and ideas that will help you invest globally and profitably. Thank you.